Hi, Steve Nison here, president of CandleCharts.com, and welcome to your next edition of Highlights, our video market newsletter for the CandleCharts.com family. Today we're going to be looking at measuring targets with all the news that's going on recently in the equity markets. I'll show you some recent equity action, and we'll start with the head and shoulders. And although my niche is candlestick charts since I revealed into the West, I've been using Western technicals since 1974. So I'm equally comfortable talking about Western technicals. And what I mean by Western technicals, classic Western tools, moving averages, trend lines, something like this, like head and shoulders and so forth. And the real power is, with the candles, is you could use both classic Western technical tools or candle signals or a combination of both. So let me show you with Western technicals how you can get measuring targets. Here, for example, is head and shoulders, a very popular pattern in here in the West. And essentially, for those who are not familiar with it, let me go over it very quickly. The market rallies, pulls back, then has another rally. The second rally is higher than the first rally. The market retreats, then it rallies again, and the third rally and the first rally are lower than the middle rally. And this is called the head and shoulders because it looks like a head and shoulders, of a person. And when you connect the lows of the head, this neckline is what it's called, the neckline of a head and shoulders. And when the market breaks under the head and shoulders neckline, it becomes a potential sell signal. Interestingly, years ago, I did a seminar at the Fed, and one of the reasons they wanted to, it was actually Federal Reserve Bank of New York, and one of the reasons they wanted me there is because they knew a lot of traders were using candlesticks. And a couple of months before my seminar, I noted that the Federal Reserve Bank did an article, and it was called, and I'm not making this up, this is the real name of the article, called The Head and Shoulders, Not Just a Flaky Pattern. I am not making that up. Federal Reserve Bank, I think was 1995, if my memory serves me correctly, or in the mid-90s. But anyway, what they found is that when there was a head and shoulders in an equity market, there was an 11% increase in trading volume when the market broke under the head and shoulders neckline. And what that told us, and I guess told them also, is a lot of traders use technicals. Anyway, so when the market breaks under the neckline, it becomes a potential sell signal. Let me show you something interesting. This is the Dow, and I'll go over why I titled this Candle Shine for Safety First Trading in a couple of minutes. This is a head and shoulders top in the Dow, and this was the neckline. Now, with classic head and shoulders, what can happen is once you break under the neckline, by the way, the neckline doesn't have to be horizontal, it could be angled like here. And also, by the way, notice how the market broke under the neckline here, but didn't close under it. So the actual close under the neckline came in early November. Anyway, the neckline, once the market closes under it, should become resistance. And let me show you something really interesting. To get a measured target, a minimum target with the head and shoulders, you go from the high of the head to the neckline, and you take that distance and you subtract it from the neckline. And that gives you a minimum target. And notice something interesting, what we got at the target. Back-to-back piercing patterns. So we got a candle signal confirming a potential target. Now, a target does not is not synonymous with support. A target means that that's a forecast where the market's going to go. It doesn't mean the market's going to stop there. So in this case, though, however, we did get back-to-back piercing patterns, white candles getting into the black real bodies on, as I mentioned, dual piercing patterns, increasing likelihood of a turn. The market ascended, and it got near the neckline, and notice what happened near the neckline. That's right, a bearish engulfing pattern. So this is classic Western technicals. You could see a head and shoulders, measuring targets, and notice how we did it on the candlestick chart. And then we got the candlestick signals to give us those early alerts of potential turns. And speaking of early alerts, now notice this slide. If I had only seen this, these are 3 reversal signals with the candles. Okay, it's beyond the scope of this session to go over what they are, but essentially a bear harami, small real body and a big real body, a dark cloud cover, and a bearish engulfing pattern. And the reason I drew that red horizontal line is that what happens, one of my favorite Western tools, among many of my tools I like adding to candlesticks, charts, is change of polarity. Old support becomes resistance. So you noted how the support area, probably should have drawn this a little closer to the lows over here. But anyway, the support area, once the market closed under it, became resistance. And look what happened from there. And let me go over another measuring technique. And in the last market, in the last slides, we looked at the Dow. I'm going to look at the S&P now. Double tops and double bottoms, and essentially a double top, and I'll tell you what the misuse of a double top is by a lot of traders. A double top is when the market makes the same highs or nearly the same highs, and then moves down. Now, most people think a double top is when you get up here, you make a high and you pull back, but a double top is only confirmed by a move, preferably a close, under the intervening low. See here, between the two highs. So a double top is confirmed only by a close under the intervening low. Just like head and shoulders top is only confirmed by a close under the neckline. And a double bottom on the right side of the slide is the opposite, two lows, and the double bottom is only confirmed by a push, again preferably a close over the intervening high. So let's look at the weekly chart in the S&P. Those two arrows show a double top here, and notice this bearish. First of all, we have a dark cloud cover here. Okay, and a bearish engulfing pattern here, a black candle wrap around the white candle. But remember, double top is not confirmed until it takes out the intervening low. So the intervening low between this high and that high is this low over here. Okay, but I would give it a little bit more leeway. And again, this probably should be drawn a little more accurately. It would be the low over here. All right. So once the market closed under it last week, that did confirm a double top. Now we could use the measuring target with the double top, which I didn't discuss in the exhibit before. But what you can do with the double top is you take the distance between the highs, and because there's a lower high than that, I'm being a little bit more conservative. You take that distance and you subtract it from from where the market broke down. So that is a potential target in the cash S&P. Now keep in mind that this could be an important support area right around 1225. We have a morning star here. We have bullish engulfing pattern here that wrapped around a black real body and a doji. But it's interesting how this measured target gives a target down to the lows made in 2005, made with this classic candle signals. And this is what we mean by early alerts with the candles. A hammer, see that hammer here, and a bullish engulfing pattern. So once again, it doesn't mean we're going to go down there right away, but this is a classic measuring technique with Western Technicals, the double top. Now keep in mind, we talked about the change of polarity before, old support becoming resistance. What would be positive for this market, and again, because it's a weekly chart, we need to wait for a weekly close, would be for the bulls to have enough wherewithal to push it back above this prior support area. So that would mean a weekly close, I would say above 1385. That would go a long way to improving the technical picture. So I hope this gives you some insight into using candle charting technique, but also to be able to use Western technicals and get measuring targets and so forth. So the main idea is this is why nobody ever goes back to a bar chart. If you're using a bar chart, you're only getting bar chart signals. But with a candlestick chart, you can use all your bar chart signals, moving averages, trend lines, the measuring targets we were showing today, head and shoulders, double tops, and so forth. But you have the added advantage of getting those early reversal signals with candles that you just can't get with the bar charts. For example, the highs that I showed you a couple of slides ago in the Dow made in October. Okay, thanks, and may the candles continue lighting your path to greater profit.